Inflation, supply chain issues, rising interest rates, record job quitting rates, yield curve inversion, war in Europe, sanctions, Russian sovereign debt default. OMG. Are we at a wily coyote moment in the history of the US economy where everything just continues to steam along unabated while in fact the floor has dropped out underneath us? Adam Gower here, gloom monster supreme, but I'm very glad to say that my guest today, John Chang, who is Senior Vice President, National Director, Research and Advisory Services at Marcus and Millichap, is going to give you a pragmatic deep dive into all the issues that are affecting commercial real estate today. It is without doubt the most important podcast that you could listen to. It is without doubt the most important topic, the most important podcast you could be listening to this week. To find out more about John and his company, go to the podcast page at gowercrowd.com, where you will find a link at the top of the page to our news channel. We have the only news channel that's exclusively dedicated to real estate crowdfunding, where you'll find a mass of information you can immediately use, from news to education, to access to every crowdfunded real estate deal on the market, updated stats, all kinds of stuff. It's totally free. Subscribe to the channel right there on the podcast page. Click the news button at the top of the page. Right. As I said, this is probably the most important podcast you could listen to this week. Why? Well, it could be all completely different next week. Basically, John Chang, an enormous pleasure to meet him. You're going to love listening to what he has to say. From Marcus and Millichap, here he is. John Chang, I'm so happy to talk to you. I'm dying to talk to you. An email came into my inbox the other day from you about the impact of Ukraine on commercial real estate. I thought, oh my God, you were the first guy into my inbox. I got hundreds of emails to talk about it. So thanks so much for joining me today. I'm dying to hear what you have to say. Of course, Ukraine is very important because that's top of mind at the moment. But what I'd like to start with, if you don't mind, is kind of a higher level overview. What is, in general, the impact of war on commercial real estate in the United States?
You know, in general, it doesn't have that big of an effect usually. Right? Because most of the time the conflicts tend to be small. There's expectations that they're going to be relatively minimal. There's not a huge implication. The difference this time is that it is a major conflict involving a world power with a lot of different countries lining up on the sides. So this is a far bigger conflict with a lot more issues involved. Normally, we don't have a lot of impact on commercial real estate, but this could be very different.
And the impact is typically, it's not directly on commercial real estate. It's more the impact on the economy as a whole that is positively related to real estate performance.
Yeah, absolutely. So it's kind of a chain sequence of events, right? So war creates uncertainty. War can impact different things. Like, again, in this case with Ukraine, there's a direct impact on the global economy, the financial systems, as well as natural resources. And there's a lot of different natural resources being impacted. We already had problems with supply chains. We were running into those because of COVID. This amplifies all of those. And as a result, it then trickles over into financial policy, fiscal policy, monetary policy, and that drives interest rates, which then impact commercial real estate borrowing. It impacts investors' uncertainty. It impacts the flow of capital in and out of the stock market and in and out of bonds. So it has a lot of different ways that it touches on commercial real estate along the fringes, but it also does drive finances and money into commercial real estate as well, because real estate is a real asset. It's a hard asset. And that's one of the places people like to go when there's uncertainty. So there's a variety of effects all across the entire economy and across the entire industry.
All right, well, let's try and drill down a little bit in specifics. And before even Ukraine, started, there were, exactly as you've described, there were a few headwinds already, right? We're talking, there's inflation, inevitability of rising interest rates, supply chain issues, et cetera, et cetera. There's quite a few things, oil prices, energy costs, et cetera. Everything was on the way up. Let's talk about supply chain. So specifically about Ukraine, what kind of direct impact, if any, can supply chain issues have as a direct result of the Ukraine war on commercial real estate? Like, what are we talking about?
Sure. So the one that's most visible right now is what's happened with oil prices, right? So there's financial sanctions on Russia, which would limit their output of oil and their ability to sell oil. And then on top of that, the U.S. has declared that they're not going to buy any Russian oil anymore. And that creates a shortfall in the amount of oil available, right? So we have a fairly consistent use of oil in the United States and all over the globe. Russia is a top exporter of oil globally. They basically deliver about 12% of the global supply of oil. So there is an effect when you try to shut that down and you reduce the amount of oil available to the world. That puts upward pressure on prices, right? You have a shortage of supply, demand is still relatively constant, and then that rolls over into gasoline prices. So you start to see that price at the pump move, and that affects people in general. Not only is there oil, but chromium and rhodium are both rare earth elements that Russia supplies a significant portion of those. Those are heavily used in catalytic converters for automobiles. We, again, already have a shortage of autos being manufactured. There's shortages of steel and aluminum. They're already affecting the auto manufacturing. This is going to compound that. So we can see it happening across various aspects of the economy. Another major export out of both Ukraine and Russia are grains and food products. And that's going to roll into effects. It could tighten up the food supplies on a global level. Not all of that rolls into the United States. We produce a lot of food here in the US. That's not a major import for us, but it does tighten the chain across the world. And as a result, that strains the supplies and raises costs for everybody.
Right. So okay. So let's look at this. And I don't, under no circumstances do I want to like throw out any gotchas or anything, or be too clever, or try to be too clever or anything. I'm really sincerely interested. I don't think anybody really knows what the impact's going to be. So it's more discursive than anything else. But here's a thought that I have about what you just said. So just talking about the increase in energy costs, right? Fuel specifically, just looking at oil, price of oil. So what this does is it inevitably increases construction costs. So let's just take, just for argument's sake, we look at a multifamily building. So now all of your projected costs of improvement, value add or construction, whatever you do, those are going to go up, right? Some component of that is going to go up simply because of increased energy costs. At the same time, you know, there's this argument that rents, and we've seen this, we could talk about this in more detail later, but there's this argument that rents are more flexible with multifamily. Yeah, if you have increased costs of transportation and commuting and household costs, etc., those are going up. At the same time as you've got costs of construction going up, you've also got downward pressure on affordability. So do you think this is going to create stress even in those asset classes that everybody's so comfortable with being recession resilient, like multifamily?
Well, I think multifamily will continue to be recession resistant, but the supply shortage, we already have a housing supply shortage in the United States, and it's pretty significant. You know, depending on who you ask, it's anywhere between 2 and 5 million housing units shortfall. And as a result, we have record low vacancy rates in apartments. We have appreciation of housing prices that are unheard of right now. The days of inventory of or the months of inventory of houses for sale is also at a record low. And so as a result, we have already a strained housing supply, and it's going to be exacerbated by this. As you said, there's going to be upward pressure on construction costs if they can get them built. And as a result, that's going to push up rents. That's going to force people to double up that were planning to move out on their own. If you look at the demographics right now, the millennial generation is primed to create new households. That's part of what's creating the housing shortage. And there simply aren't enough housing units out there. We expect about 400,000 new apartments to be built in the United States. That is the most apartment units to be built in any single year since the 1980s, and yet it won't be enough. And now with this new pressure, the ability to get to 400,000 units is going to be restrained. I don't think we're going to get to that projection going forward, just because we have so many barriers in the way and so many headwinds. So this is going to exacerbate the issue.
Yeah, it's interesting. I do remember during the last downturn, the big downturn, 2007, 8, 9.
Yep.
I was working for a bank, as I mentioned. The only asset class really that was consistently outperformed everything else was multifamily, even with affordability issues, right? As people lost their jobs, and there were all kinds of downward pressure on economic stability or whatever in that time. Multifamily always outperformed. Now, what about, just sticking with Ukraine again, what about the impact of sanctions? This is a big question. It seems easy for us to think we've crushed the Russian economy, but what is the impact of that?
Well, again, it creates ripples throughout the financial system, right? It creates instability. There's risks of a Russian default on their debt. And that could cause more problems within the banking system and the financial systems. So there is a knock-on effect possibly out there. Structurally speaking, for commercial real estate, the effect of the sanctions is kind of more long-term. We'll see it a little bit at a time. I don't think we see a shock to the system per se. We already had the Federal Reserve taking a more hawkish position. But in fact, actually, the sanctions and what's going on in Ukraine actually caused, I believe, Chairman Powell and the Federal Reserve to actually take a slower action this time around. We only had a 25 basis point increase in the first rate increase. There was a possibility they would have gone more, but I think because of the anxiety about what's happening in Ukraine, because of the sanctions, because of the uncertainty that's creating, they took a more cautious approach.
Yeah, it's interesting you mentioned that. So let's talk about rising interest rates, and we'll come back to sovereign debt default as well, because that was another topic. Because it's really difficult to understand and unravel it. Just seems like a confluence of really bad things all happening at the same time, right? So, but it's kind of nice to unravel each one individually. So rising interest rates, let's talk about that just for a moment. 25 basis points, but another 6 of them this year, right, projected. So now we're talking about 150 basis points against, right? Is that right? Am I going to
175?
175, yes.
Right, 1 plus 6 more.
Right, 1 plus 6 more, exactly. You know what they say? There are 3 types of real estate professional. Those that can count and those that can't. 1.75%. That's enormous. I mean, that's doubling. I mean, over doubling what the basis is now. So it only seems very small because it's only 25 basis points. But as a multiple of what there is right now, it's absolutely ginormous. What do you think the impact of that could be on commercial real estate when there's so much activity and so much liquidity in the market as there has been up until now?
Yes, absolutely. And first of all, it's 175 if they're all 25 basis point increases.
Right.
Some of them could be 50s,
yes.
Right? So it's going to be at least 175. And right now, the 10-year Treasury is at just over 2%, 2.1, 2.2, depending on the day and the time. So yeah, we could be doubling the interest rates over the course of the year. Now, the Fed is responding to the highest inflation we've seen in 40 years. it's far far more entrenched than they had originally broadcast, right? They kept saying transient, 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 and then they decided that transient probably wasn't correct. And now they're still saying that they think the inflation is going to go away by the second half of this year, or going to come down dramatically. I really question that personally. But what is the effect of raising rates at least 175 basis points? We recently did a survey of investors, and we said, okay, if interest rates go up by 50 basis points, are you going to change your buying activity? And really, at 50 basis points, very few people cared. I think it was about 6% said, yeah, I'll reduce my purchasing. We said, okay, what about if it's 100 basis points? And then 19% said, yeah, I'd probably reduce it. But again, in the global perspective, that's not very big. Once you get to 150 basis points, now it tipped. 46%, almost half of the buyers out there say, yeah, I'm going to slow it down. So we know that somewhere around 150 basis points is the trigger point, is the tipping point in investor activity. And so by the end of this year, we may be at that point. Now, there is a ton of capital, right? Real estate, it tends to be a pretty good inflation hedge. Real estate is a good place to park capital during times of uncertainty. It is a good place to park capital when there's volatility. So you have these two forces that are battling, right? On one hand, you have very low cap rates, interest rates rise, you get a yield compression, and actually you could end up upside down in your first year of operations, depending on your cost of capital and how much leverage you use. So this is on one side. On the other side it's really one of the best places to put your capital. So I anticipate the first half of this year is going to be very active, very strong. We're going to see a lot of activity because it's going to take time for the Fed to move those rates up. And they're not going to do it all in one fell swoop. They're going to do it a little bit at a time. Every couple of months, they're going to hit it again and again and again. And so by the end of the year, this will likely see a slowdown. Now, there's a lot of moving parts in there, right? If inflation is still high, if we see more uncertainty in the stock market, we see money coming out of the stock market, some of that's going to go into real estate. So it could honestly go either way.
Yeah, so this is very interesting. Actually, and by the way, I am a doom and gloomster deep down. So let me just pursue a bit of doom and gloom for you. So everybody's been, we've watching this overheated market, cap rates insane, like sub threes all over the country. It used to be just the west side of LA. Now, I mean, really everywhere, right? Seriously. And everywhere, and almost every asset class. It's not just multifamily, it's just compressed everywhere. As you know, obviously I'm overgeneralizing, but we all know that's the truth, right? Basically. So if at 150 basis points, I think you said 150 basis points or 100 basis points, you see this 46% decline in intent to buy. So the reason for that, if I read between the lines right, is because it's going to cost too much and cap rates are too low. Yep. Right? It doesn't make sense. Therefore, does that not mean that cap rates will start to come up? And if they do, what about all those people that have been buying under the assumption that our cap rate is going to be nicely stabled at 3 or 4%? What's the impact going to be on all the people that are bought with those assumptions, you suppose?
Okay, so it is not necessarily true that cap rates will rise. Okay, if you look back over time, we've seen the spread between the 10-year treasury and the average cap rates compressed very tight. Back in 07 and 06, now granted, there was a lot of enthusiasm in the marketplace and cap rates were compressed pretty tight, but the spread got very, very thin at that point as well. So it is not a foregone conclusion that cap rates in general will rise. Now, the place where we're most likely to see it is the places where you have a 2.5 cap, a 3 cap, right? The other place you're going to see it is on assets where you have less ability to move rents, things like net lease investments that are tied into a 15-year lease, right? They're going to soften up a little bit because that's a coupon clipper. And just like bond yields, would be coming up, you're going to see that in those bond-like types of commercial real estate. Now, for the investor who went in and bought a great apartment asset in a great market with lots of growth, they bought it at a 2.5 cap. They're not going to have a problem, right? Even though cap rates are going up, that's influencing their exit strategy downstream, right? You never realize that new cap rate until you actually sell it. And so their yields are going to be as they plan, assuming, okay, we're going to raise rents over the course of the next several years, and our cap rate will rise. We may have bought an apartment building in Austin where you have great employment drivers, you're going to have great in-migration, the demand for housing exceeds the supply, and you're going to raise your rents and you're going to grow that revenue. So I already bought it at 2.5 cap. Rising cap rates don't really mean a lot to the performance of that asset until I sell it later. Now, hopefully, if you bought that at a 2.5 cap and you sell it later, hopefully you're going to sell it at a similarly low cap rate. But if you have to exit, right, if you get the end of a fund and per the rules of your fund, you have to sell that asset, and then cap rates are now for that market maybe a 3.5 or a 4.5. Yeah, you're losing out on that deal.
Yeah, that's not true. You're going from 2.5 to 4.5.
Yeah, but in the meantime, you saw
that's a 50% drop in value, John.
But in the meantime, your rents have gone up. In that kind of a market, you may be seeing rent growth of double-digit rent growth every year along the way. In which case, if you're achieving that, you're going to offset that.
Right. So
those not what you want. Right.
Big ifs. Right.
As an investor, when you wrote that check and you bought it, you didn't say, gosh, you know what? I hope, cap rates go up 200 basis points between now and when I sell it. That's not what you're thinking, right? You're thinking, hey, I want to sell it later at a comparable cap rate. But the underwriting was based on rent growth and revenue income growth. And then again, particularly syndicators and funds where they have a strict end of life on these funds and a timeline that they have to hit with the sale of that asset, then those guys are gonna they're shaking the dice a little bit.
Let's go back to Russia for a moment.
Sure.
And Russian sovereign debt default. So what actually does that mean?
I don't know. Honestly, this is, it's one thing for Greece to go in default, right? In a regular time or in a financial crisis mode. And then the banks and the financial institutions sit down, they work it out. It's an entirely different situation for a global power to default, especially one that's already demonstrated that it doesn't really care what the rest of the world thinks, right? So theoretically, there should be financial repercussions. There should be banking repercussions. There's the whoever loaned them the money, whether it's Deutsche Bank or somebody else, is going to want to recover those funds, right? And they're going to put pressure on them to do it. But it's really hard to do with a country like Russia. This isn't a small country in the EU where they're playing by certain rules, right? The rules in the EU are very specific about how this is going to be handled. The rules for Russia are completely different, and they get a say in what those rules will be. So I can't say exactly how this is going to play out. I can say it's not going to be good. It's not good for anybody, but we haven't seen something like this before.
Right. And so actually your answer is the most telling, because if somebody as knowledgeable and as well read as you are about the economy and about the impact of these kinds of things, if your answer is I don't know, then what we know then is that there is considerable uncertainty. And in that wonderful short video that you put up on LinkedIn that I recommend everybody go and watch, it's on your profile on LinkedIn, you talk about the impact of uncertainty on commercial real estate. So talk to me a little about, this morass of stuff going on. People, even like you, don't know what's the impact. Nobody really knows. What is the impact of uncertainty on commercial real estate?
Well, uncertainty, when people have uncertainty, they have a tendency to move to somewhere safe, right? And for some investors, that means bonds, right? And for other investors, that means real estate. So again, uncertainty can drive capital into their perceived safer assets. I was speaking at a medical office conference a couple months ago, and I was talking to our brokers and saying, okay, what are people looking for right now? And they said, well, they want 12-year or 15-year leases with high quality tenants, and they're buying them at a 7 cap, right, or 6 cap. And I said, well, why are they buying these? And they said they want that safety. There's instability out there. They want to have durability of income. They want to know what to expect. And in the case of medical office specifically, they're also banking on population growth of the elder population as baby boomers age, and the demand for medical office space will rise over time. So they're going to see appreciation on that side of the asset. So that is one strategy I'm seeing people play out. But in general, uncertainty causes people to move to safer ground. And real estate can be a big piece of that. I know a lot of the investors that I talk to are trying to put more money into real estate because they're not sure where things are going to go over the next couple of years.
Yeah. So I'm going to ask you a couple of questions, and then we'll come back to some other kind of interesting things I've been seeing in the economy. I'm all over the place, but inflation. So I'd actually stopped asking you about inflation because you touched it so well. I'm now going to ask you something that I know that economists love to talk about and do, and that's to predict the future. I know that that's what you love to do all the time. So how severe do you think inflation can get? I actually was asked recently about hyperinflation, and I'm not sure the person asking me actually knew what that meant, but you do. Hyperinflation being hundreds or thousands of % a day. Yeah. What has something crazy? Yeah. What do you think? Like, what are the scenarios, realistic scenarios you think could play out with inflation? Oh, you fell over when I asked. That happened.
Yeah, right. Sorry, my phone's being so hyperinflation is pretty much off the table. I don't expect that at all, right? That's where you could actually see prices move during the day, right? Where you see things happening on a day-to-day basis. Right. But we could see elevated inflation. You know, right now, depending on which measuring stick you're using, is somewhere between 5 and 8%, 7.5%, 8%. Depending on if you're using CPI or core CPI or PCE or core PCE, there's a whole bunch of different options. Right. But what I can say is all of them are higher than they're supposed to be. Mm-hmm. Now, will they keep going up? If you look at a graph showing what's happening with inflation, that graph doesn't look like it's leveling off. It looks like it's still going up, right? So, I look at it and go, okay, if you were measuring this on trajectory alone, it's going up. Now, looking underneath the surface, the key drivers of inflation right now, you look at the cost of goods used in manufacturing, the producer price index. That's rising, that's accelerating, right? The underlying materials, the raw materials, we have all of these sanctions going on with Russia that could cause further reductions of availability of raw materials, right? There's also issues with the pandemic going on in China right now, which is reducing the availability of raw materials. We have some tariffs still in place that are slowing down availability of materials out of other countries. You know, we have lumber prices that are still quite high. They're double what they were before the pandemic. The price of steel is 3.5 times what it was before the pandemic. The price of aluminum is double what it was. Right. Those things have all been going up lately. They haven't been going down. We just produced our national investment reports, right? Our forecast for 2022. And I spent my morning this morning down at the printing company because the printing company, they're a huge printing company, ran out of paper. They can't get paper right now. So you see all of these shortages. Okay, those shortages translate into inflation. In addition, you look at the cost of housing. That's rising pretty aggressively. You look at the price of wages, right? Wage inflation is 5.5%. Normally it's 2.5%. So it's double what it would normally be. So we see all of these drivers, not just the headline number, not CPI, not core CPI or PCE. What you have are underlying drivers of inflation that are still very high and in many cases rising, which implies that this is going to be around a while, which implies it could keep going up over the next few months. And I think this is why the Federal Reserve at their meeting on the 15th of March came out and said, hey, this is a little worse than we thought. We're going to hit this a little harder than we originally talked about. Right. And so that's why the Fed is going to try to grapple with this beast. It's going to be a big challenge for them.
Well, you know, there's one thing that you missed, and because it's so huge, it's easy to miss it. It's like the wood for the trees. But we've also had a gazillion dollars of stimulus go into the economy. I mean, the amount of liquidity, I've never seen. I've been, since I started in real estate in the United States, 1982. Interest rates were 20. You get 12% on deposits at the bank, and interest rates on mortgages were 20%.
Yep.
I've never seen anything like the kind of liquidity that there is in the markets at the moment. It is out of control.
Well, we had a lot of stimulus, right? So during the pandemic, we put about $5.5 trillion into the economy, injected cash,
right,
from Congress. That has put a lot of pressure on the market. Now, the other side of this that we don't talk a lot about is the amount of cash in savings, right? And I'm just going to take a look here. If you look historically, if you look at the level it was before the pandemic and compare it to where it is today, there's $5.8 trillion more in savings and money market mutual funds today than there was before the pandemic.
Okay? What is that as a percentage, John?
How
has that changed?
Let me do some quick math for you. We're up about 6 trillion off of, it's about 30%.
Really?
So there's about 30% more cash in savings and money market accounts. That's liquid. That's money sitting in the bank, a savings account, right? And the thing is that the uncertainty keeps it in the bank account, right? Because when you are uncertain, you put it somewhere safe, right? You put it in your savings account.
Under the bed.
Now we have been talking about after the pandemic eases and people are feeling more comfortable, we get back out, we go shopping, all that money is going to get unlocked. It's going to go back into spending. Okay. Now with the war in Ukraine, that extends that uncertainty and amplifies it a little bit. So that'll stay locked up. We might actually see more compounding and savings, more money getting put away. But when that money gets out, that's more spending coming into the marketplace. That puts more pressure on inflation.
Exactly.
Yep. So,
all right. So here's go ahead.
I'm just saying that there's more fuel that we can throw on this fire at some point, right? It's sitting on the sidelines. The Fed is doing what they can to tamp it down without freaking everybody out, right? But the other challenge the Fed has to consider is the risk of inverting the yield spread, right? The risk of a inversion, and that happens when the short-term interest rates go higher than the long-term interest rates. We usually use the 2-year versus the 10-year.
Perfect.
Spread is about 25 basis points. Now, when they raise the overnight rate, right, the federal funds rate, that's the overnight rate. That puts upward pressure mostly on short-term rates. Okay. But they don't want short-term rates to go higher than the long-term rates. So at some point, they're going to have to put upward pressure on the 10-year treasury and the longer-term interest rates. They're going to do that probably, in my opinion, through quantitative tightening. Now, they alluded to this on their March 15th in the press conference after their meeting on the 15th, and they said they're going to reduce their balance sheet, right? They said, we'll probably do it something like we did last time, but, we might change things up a little bit. Now, the Fed's balance sheet went from 4.4 trillion before the pandemic to now it's at 8.8 trillion. It's doubled. Okay, that's a lot of money. That's another $4.5 trillion sitting there on the Fed's balance sheet. They're going to try to pull that down. When they do, that means that they'll either let treasuries mature or they will start selling them off. I think at some point this year, they'll start selling them off in order to put upward pressure on interest rates. So we can expect that to come out. They want those long-term interest rates to stay above the short-term, and they got to keep that spread open, because if the yield curve inverts, that implies, it suggests that there will be a recession. And the last thing they want to do right now is telegraph to the to everybody, hey, by the way, there's an inflation, there's a recession coming on top of all this.
It's funny actually that you should mention that, because that was my next question. The fives did go above the tens briefly, I think yesterday or the day before. And I was going to ask you, do you think that another one of those lovely questions I know economists love, predict, do you think there will be a recession? Are we headed to a recession? Is there any way of avoiding a recession?
Well, there's a flippant response, which is at some point in the future there will be a recession, right? But we had a webcast with Hank Paulson. We had a webcast with Hank Paulson about a month ago. And he said, if you look back on history, the Federal Reserve's ability to have a soft landing when you have high inflation is very low. They haven't ever done it.
That's interesting.
So we need to be prepared. Now, we just had a recession, right? Now, we had this huge drop in employment. We technically had negative GDP for a very brief amount of time. It was almost like this flash recession, and then we moved on and everything was fine. So not all recessions are the same.
Yeah, because this last one, everyone was sitting at home watching the television during the last one. It wasn't like, it really hit, the economy really died down anyway. There was very little activity.
Yeah,
that's
it's not like 08 or 09, right? The Great Recession.
No soft landings during periods of high inflation. That's interesting. I mean, the funny thing is, John, like I say, when I first came to the States, I remember you could deposit in the bank and get 12%. When I came back from Japan, I lived in Japan for 10 years in the 90s. My first mortgage that I got when I bought a house was like 7.5%. And I thought it was an absolute steal. I think anything under 10% is like free money.
Yep.
Right? Because we were in the early 80s, people in mid 80s, people were paying 20% on a mortgage.
Yeah.
So 7.5 to me was like, they were like picking up money in the street. So today, but when you come from this long period of time with super low interest rates, it really does have a different impact. John, I got a question. There's another interesting indicator. I see you looking at the time, so we'll wrap up in a minute. I've got some sign-off questions for you as well. But let me ask you this. It's an interesting question. And we'll wrap up as far as the economy on this question. One of the trends that I've been noticing, others have been noticing as well, is record job quitting trends in the United States. What do you think? What can we learn from that interesting dynamic?
Okay, so there's a lot packed in there, right? So we went into the pandemic, we had this huge layoff, right? We lost about almost 23 million jobs. Okay, that was huge. Over the next few months, we recovered, we bounced back, we got a lot of those jobs back, but we were still in a pandemic. And during that pandemic, we saw a lot of the baby boomers who were working into their 60s, who had always considered retiring but never had, decided, you know what, now's the time. I'm done. I'm going to retire. So we saw that. We saw a lot of people decide, okay, I'm not going to work. I'm not going to go back to work. I'm going to take care of my kids or somebody else. I'm going to care for somebody else. That is another big chunk of population. Those all exited the workforce. We saw a lot of people move. We saw a lot of people migrate from high cost center markets like in New York or the Bay Area and relocate to other cities across the country where they took a high, very expensive market salary with them to some place with a very low cost of living. And then they looked at their significant other and said, hey, by the way, you don't need to work. Our cost of living just got cut in half, but I'm still making great money. And so we saw a lot of people exit the employment market from that. Now, that drives a labor shortage, right? We're basically at a 5 million person shortfall. If you look at the number of job openings versus the number of people actively looking for work, the unemployment rate, there's about 5 million more jobs than there are people looking for work. That's a shortage. That's driving up wage pressure, but it's creating a very aggressive recruiting climate and a lot of opportunity. So, historically, normally, when you have job dissatisfaction, you suck it up and carry on, right? You just keep moving forward. You're like, okay, I'll get past this. I'll keep moving. I'll solve this, and it'll be fine in the future. And you suck it up. Now today, because there's so many jobs available, so much demand, so many opportunities, I'm not going to suck it up. I'm going to take it. I'm going to quit. I'm going to go out. I will find another job. It's fine. There's so many to choose from. There's recruiters calling every day. It's okay. So the quits rate has gone up a lot because there's this huge labor shortage, and there's a lot of jobs being created because we have good economic growth, right? We can't forget, as we talk about all these risks, inflation and rising interest rates and all these barriers to growth, we cannot forget that economic growth last year was quite strong, and that the forecasts, even with all these headwinds, are still pretty good. Depending on who you ask at any given time, is somewhere 2 to 4% expectations of economic growth this year. So there are opportunities, and that job dissatisfaction is people aren't going to put up with it. They're going to move on. They're going to go find something else. They may even change into a different city, wherever they want to go live. A lot of movement into the southern states, into the quality of life. We see migration to Texas and Florida and so on,
Right.
and that will continue. So I guess the key word there is take care of your employees. They're golden right now. There's really nothing more important right now than the quality of the people who you have working for you.
Yeah, it's really interesting you say that. Actually, I am constantly approached by our clients. Do I know any good investor relations guys? So if there's anyone out there who's a good investor relations guy, wants to move or wants to start doing that, let me know, because I've got a list of people. John, let's wrap up with a couple of softballs, I guess. Just easy questions to ask. Actually, this one's not so easy. For a commercial real estate investor, I've got an easy one as well. I promise you, I do have an easy one.
Sure.
Commercial real estate investors, what advice would you give them? If there was one thing that you wanted them to take away with today, March, whatever it is, height of the Ukraine crisis, goodness knows what's going on, dating this podcast, what advice have you got for them?
Okay, so you have to figure out what are your plans, right? What's your big strategy? But if your strategy includes buying commercial real estate sometime this year, next year, whatever, do it now. Move fast, right? Interest rates are still low. There is inventory available. Go out, get your capital placed. Don't put on variable rate debt, right? Put on fixed rate debt, get it locked in, and you're ready to run. If you are thinking of selling a property, guess what? Do it now. Why? There's a lot of buyers in the market right now because they can get financing. So if you wait to sell a property a year or 2 years down the road, you may not be getting as good of a price, right? Now, I said earlier, just because interest rates are rising doesn't mean cap rates will rise. However, they might. And so if you're thinking of selling, you want to do it sooner rather than later. The market is really strong right now, and it is a great time to sell your assets if you're going to harvest, if you're going to take chips off the table. The other part of it, and we haven't talked about this either, is that we know what capital gains tax rates are right now. They're 20% at the top, right? There always is a question, will those move? Will they move down? Probably not. Will they move up? Maybe at some point, but you know what they are today. So if you're thinking of selling, if you're thinking of taking chips off the table, now is about as good a time as you're going to see over the next couple of years. So it is, I guess that's my best advice to investors, to real estate investors. Now, if you're not planning on buying or selling, then make sure you're allocated in the right spaces, right? You make sure you have something that meets your inflation risk appetite. Make sure you have something that meets your broader financial goals. And you can sit down and you can wait this out.
All right, I got to ask you one question because I'm constantly looking for last one. This is the last one. Favorite book? What's your favorite one? I'm like constantly looking.
Favorite book?
Yeah.
Actually, my favorite book is called Thriving on Chaos. Okay.
Oh, I love that.
And the reason is because when I first read it, it changed my thinking, and it is so appropriate for right now, right? We have all this instability. That's what we've been talking about for this entire conversation, is instability and uncertainty. We are living through a period of complexity and chaos, and that creates opportunity. Those opportunities are what you need to be focusing on. That's rather right. Than sitting back and going, oh no, what do I do? Thriving on chaos is the way to go. I think that there's a tremendous number of things you could be doing right now to grow.
I love that. It's got such a positive attitude, silver lining stuff. That's Thriving on Chaos. I've pulled it up on my screen. Tom Peters.
Yep.
I'm going to add that to my list. John Chang. I'm not sure what your title is, so I'm just going to call you Chairman and CEO at Marcus Millichap. Should be anyway. Go on, what's your title? Your chief.
I'm the Senior Vice President of Research and Advisory Services. Ironically, our current CEO, Hassam Naji, used to have my job. So I've learned from the best, and now he runs our company.
So we know what path you're on, John. I'm so happy. I'm so glad that you joined me today. Thanks so much. Really important podcast. We'll get it out soon. Thanks for joining.
I appreciate it. It's been a joy.
That was John Chang, Senior Vice President, National Director of Research and Advisory Services at Marcus Millichap. Be sure to check out links to John on the podcast page for this week's episode at gowercrowd.com. And also click the news link at the top of that page where you will be able to subscribe to our newsletter. It's the only one, it's totally free, and it's the only one that is exclusively dedicated to real estate, crowdfunding news, real estate syndication news, updates on everything that's going on in the industry, all the deals everywhere. There's a whole page on every deal that's advertised online. We scrape all kinds of stuff from the SEC. It is the motherlode of real estate investing information, all there at gowercrowd.com. Hey, John Chang, Senior Vice President at Marcus Millichap. What an enormous pleasure to meet you. Thanks so much for joining me today on the podcast. And thank you too for having spent some time listening in today. That's all we have for today. Be well, stay safe. And for now, this is Adam Gower signing off.